Let me ask you something. Can saving too much money actually harm your financial future? Sounds ridiculous, right? After all, we've all been told since childhood that saving is the cornerstone of financial stability. From the moment you got your first paycheck, you've probably had advice like save for a rainy day or put aside every spare penny. But what if I told you that blindly hoarding money could be one of the biggest financial traps out there? The idea might sound absurd at first, but here's the truth. Saving excessively, without a strategy for growth, can prevent you from achieving true financial freedom. Stay with me, because by the end of this video, you'll have a completely different perspective on what it means to manage your money wisely. You might even discover that the habits you thought were helping you might actually be holding you back. Why saving too much can be dangerous. Before you roll your eyes or dismiss the idea, let's get something straight. Saving money is absolutely essential. Everyone needs an emergency fund, a safety net for life's unexpected curveballs, and a plan for retirement. These are non-negotiable pillars of financial security. But there's a fine line between being financially responsible and hoarding cash at the expense of long-term growth. The problem arises when saving becomes an obsession, or worse, when it becomes your only strategy. This excessive focus on saving can create financial stagnation, leaving your money sitting idle while inflation and lost opportunities quietly chip away at its value. Inflation eats away at your savings. Here's the first shocking truth you need to understand. Your savings are losing value every single day, thanks to inflation. Inflation is like a silent thief that erodes the purchasing power of your money over time. For example, $10,000 saved in a regular bank account 10 years ago might still be $10,000 today. But what you can buy with that money has significantly diminished. Prices for goods and services rise year after year, and unless your savings are growing at a rate that outpaces inflation, you're essentially falling behind. In some cases, the difference is staggering. Think about this. If inflation averages 3% annually, your money loses nearly half its purchasing power in 24 years. That's why simply parking your cash in a savings account is like watching it shrink in slow motion. The missed opportunity of investments. Now let's dive into one of the biggest missed opportunities when it comes to saving too much: the power of investing. Every dollar you save and don't invest is a dollar that isn't working for you. Let's break it down. Imagine you have $50,000 sitting in a savings account, earning a measly 0.01% interest, essentially nothing. In 20 years, that money might grow to $50,100, a laughable $100 gain. Now compare that to investing it in the stock market, where the average annual return is around 7% after inflation. That same $50,000 could grow to over $193,000 in 2 decades. The difference is monumental. By saving excessively without investing, you're depriving yourself of the magic of compound interest, a powerful force that allows your money to grow exponentially over time. And here's the kicker: the earlier you start, the more powerful that growth becomes. The psychological trap of saving too much. Money isn't just numbers, it's deeply tied to psychology. Our beliefs, fears, and habits around money often dictate how we manage it. Saving excessively might seem like a responsible thing to do, but it can create an unhealthy mindset that ultimately limits your financial potential. Fear-based financial habits. Many people save too much because they're driven by fear. Fear of running out of money, fear of economic downturns, or even fear of losing control over their finances. While caution is a good thing, letting fear dominate your decisions can lead to financial paralysis. Instead of viewing money as a tool to create opportunities, you start treating it as a security blanket you're afraid to let go of. This fear-based mentality can prevent you from taking calculated risks, exploring investment opportunities, or even enjoying your life. The result: you might feel safe in the short term, but you're actually sacrificing long-term growth and freedom. The false sense of security. One of the biggest misconceptions about saving is that a large bank balance equals financial security. But here's the hard truth: having a pile of cash doesn't necessarily mean you're financially secure. Ask yourself this: is that money protected from inflation? Is it earning a return that outpaces the rising cost of living? Or is it just sitting there, losing value day by day? Real financial security comes from a diversified strategy that includes saving, investing, and creating multiple streams of income. Without these elements, even the largest savings account can fall short. How to save smarter, not harder. Now that we've identified the dangers of saving too much, let's talk about what you should be doing instead. The goal isn't to stop saving altogether, but to save with intention and balance. Here are some actionable steps to help you optimize your savings without sacrificing your financial future. 1. Build the right emergency fund. Every financial advisor will tell you the importance of having an emergency fund, but how much is enough? The rule of thumb is to save 3 to 6 months' worth of living expenses. This provides a solid cushion for unexpected expenses, like medical bills, car repairs, or job loss. But here's the key. Once you've built that emergency fund, stop saving excessively. Any additional cash beyond this amount should be redirected into investments or other wealth-building opportunities. Leaving too much money in your savings account is not only inefficient, but also counterproductive in the long run. 2. Pay yourself first, but invest the rest. The pay yourself first principle is one of the most popular pieces of financial advice, and for good reason. It ensures that you prioritize your savings before spending on discretionary items. However, there's a caveat. Paying yourself first doesn't mean keeping all that money in a low-interest savings account. Once you've covered your emergency fund and short-term goals, the rest of your savings should be put to work. This could mean investing in index funds, ETFs, real estate, or even starting your own business. The point is to make your money grow instead of letting it sit idle. 3. Understand opportunity cost. Every financial decision comes with an opportunity cost, and saving excessively is no exception. Opportunity cost refers to the benefits you miss out on when you choose one option over another. By saving too much, you're potentially missing out on higher returns for investments or life experiences that could enrich your future. Ask yourself, is this money better off sitting in a bank, or could it be earning me more elsewhere? 4. Learn to balance today and tomorrow. Life isn't just about the future, it's also about the present. Saving excessively often leads to a scarcity mindset, where you feel guilty about spending money on yourself or enjoying life. Want to take that dream vacation? Do it. Want to enroll in a course that could boost your career? Go for it. The key is finding a balance between living for today and planning for tomorrow. Financial freedom isn't just about accumulating wealth. It's about using that wealth to create a fulfilling life. The magic of strategic investments. If there's one lesson to take away from this video, it's this. Saving is not the same as building wealth. While savings can provide a safety net, investments are what create financial freedom. So, how do you transition from being an oversaver to a smart investor? It starts with understanding the types of investments available and how they align with your goals. The power of diversification. Investing isn't about putting all your money in one place and hoping for the best. The golden rule of investing is diversification, spreading your money across different assets to reduce risk. Think of it like this. If one investment underperforms, others in your portfolio can help offset the loss. Diversification can include stocks, bonds, real estate, mutual funds, and even alternative investments like peer-to-peer lending or cryptocurrencies. Each of these assets behaves differently under various economic conditions, which means your portfolio is more resilient to market fluctuations. For example, during periods of high inflation, real estate and commodities like gold often perform well, while bonds may lose value. Understanding these dynamics allows you to position your investments strategically, ensuring your money is working as hard as possible for you.